The Department of Labor has been busy of late. As I explained in a previous video, in October of 2010, DOL came out with new rules that will require your 401k plan to tell you how much you pay in fees for your 401k account. And now the Department of Labor has proposed rules on what 401k participants must be told about target date funds, or TDFs. As you probably know, these funds are an increasingly popular choice among 401k investors. You choose a fund with a date that corresponds to when you plan to retire, and you not only get a completely diversified portfolio in one fund, but the mix of stocks and bonds automatically becomes more conservative as you age. Despite the convenience target date funds offer, however, they've also generated a bit of controversy, in large part because there's no uniformity in how these funds divvy up their assets. That became an issue during the financial crisis, when some 401k target investors on the verge of retirement found themselves fairly heavily invested in stocks and suffering losses of as much as 40%. To avoid such rude surprises in the future, DOL wants to help 401k investors better understand what they're getting when they invest in one of these funds. Specifically, DOL would like to see 401k participants receive three things. First, an explanation of the fund's glide path, or how the target date fund's stock bonds mix will change over time, including disclosing when it will reach its most conservative position. Second, a graph that illustrates that glide path. And third, an explanation of what the date on the fund means. This requirement is meant to address the to versus through issue. For example, a 2020 fund that assumes you're investing to 2020, that is, you'll withdraw all or most of your money from the fund when you retire that year, will likely have a much more conservative investment stance with more bonds than a through 2020 fund that assumes you'll continue to hold the fund or a comparable portfolio throughout a long retirement. At this point, these are only proposed rules, so we'll have to see what the final regs actually look like. But if you own a target date fund or are thinking of investing in one, either in your 401k or in another retirement account, there are a few steps you can take in the meantime to see whether your fund is right for you. First, check the fund's stock bonds mix. Many 401ks already provide this information, so you may be able to get it on your plan's website or from your HR department. If not, see if there's a retail version of the target date funds your plan offers. If so, you can check the fund's prospectus to see how it allocates its assets and how that allocation changes over time. Going to the website of the fund company that offers the fund might also provide some insights. For example, Fidelity, T. Rowe Price, and Vanguard all have interactive tools that show the glide path their target funds will take. Second, decide if that mix is right for you. If you think the target date fund for someone your age is too aggressive or too conservative, you can get around that by picking one with a different date. If you prefer more stocks, go with a fund with a later target date. If you want one with more bonds, go with an earlier target date. Or you could add another stock or bond fund to your holdings. And finally, don't forget about expenses. Convenience is great, but you don't want to overpay for it. Ideally, I'd say you want to keep annual fund expenses below 1%. If your target date fund's expenses are much higher than that, then maybe you're better off mimicking the fund's investment strategy using lower cost index or institutional funds if they're available in your plan. The point, though, is that even something as straightforward and convenient as a target date fund isn't a complete no-brainer choice. So before you invest in one, do what you can for now to evaluate what you're getting and understand that doing such an assessment is likely to get easier in the years ahead.